Your property tax bill came to $18,000 this year. State income taxes on your pension added another $6,000. $24,000 in state and local taxes, and the IRS allowed $10,000 of it on your federal return. Not because of an audit, not because of an error. The SALT cap, a single limit in the federal tax code that held every homeowner who itemized at $10,000 in state and local deductions, regardless of what they actually paid. It ran that way for 7 straight tax years, from 2018 through 2024. $14,000 in real taxes you wrote the check for, simply not deductible. Starting with the 2025 tax year, Congress raised that cap. In 2026, after 1 year of annual indexing built into the law, the figure is $40,400. That is a real change that can move your return. But the same legislation buried a phase-out clause that can walk your limit right back down toward $10,000. Based on one income number most retirees do not check before they plan their year. That clause is what almost no one explaining this law is covering. I am your guide to real-world retirement decisions. In the next 15 minutes, you will see exactly who the new cap helps and by how much, how the hidden phase-out works, and why the income number that triggers it may be closer than you expect, and what 3 steps to take before year-end so you have both gates covered. Before Part 1, here is the gate you have to clear first. To benefit from the higher SALT cap, your total itemized deductions have to exceed your standard deduction. Here is the 2026 bar. A couple where both spouses are past 65 gets a combined baseline of $35,500 before itemizing even helps. A single filer past 65 clears the bar at $18,150. If your itemized total does not clear those numbers, the new cap does not appear on your return. That is the first gate. We are going to find out whether you clear it. Quick ask before we start. If this kind of research saves you from missing a real deduction, hit like and subscribe now, so the next one shows up for you automatically. First, let's define exactly what SALT is and what just changed. SALT is the IRS shorthand for state and local taxes. On your federal return, you can deduct your property taxes plus your state income taxes. If you live in a state with no income tax, you take state and local sales taxes instead. You pick whichever is higher between income taxes and sales taxes. Your property taxes then combine with whichever one you chose to form your total SALT deduction. Before 2018, there was no dollar cap on SALT itself, though for some higher income filers, the separate alternative minimum tax could already limit how much of that deduction actually helped. Then, the Tax Cuts and Jobs Act added the flat cap most retirees recognize today, $10,000, starting with the 2018 tax year. $5,000 for those filing married separately. For homeowners in states where property taxes alone regularly exceed $10,000, this was a permanent annual cost hidden inside the tax code. A homeowner paying $15,000 in property taxes could write off $10,000. The other $5,000 was simply not deductible, taxed at their marginal rate year after year. The One Big, Beautiful Bill Act raised that cap beginning with the 2025 tax year. The 2025 limit was $40,000. In 2026, after 1 year of annual indexing built into the law, the limit is $40,400. For those filing married separately, the 2026 figure is $20,200. And every other number in this video, the phase-out threshold and the floor, is also cut exactly in half for that filing status. The cap continues to increase by 1% each year through 2029, so the exact number shifts slightly in 2027, 2028, and 2029, but the structure is the same. One additional change that affects your calculation if you give to charity. Starting in 2026, charitable contributions for itemizers are only deductible above a floor of 0.5% of your adjusted gross income. At most income levels, this is a modest adjustment, but it reduces your itemized charitable total slightly and is worth including when you run your numbers. Now, let's figure out who actually benefits and by how much. You have the standard deduction thresholds from the gate above. The question now is who actually crosses them once the new SALT cap is in place. One note before the example. The same law also includes a separate temporary deduction of $6,000 per person for taxpayers age 65 and older. Unlike the old additional standard deduction for seniors, this one is available whether you itemize or take the standard deduction. It phases out at higher incomes, above $75,000 for a single filer, $150,000 for a married couple. So it is not automatic for every household in this video's phase-out discussion. It is a separate calculation from the SALT question and runs through the 2028 tax year. The thresholds I have been using: $35,000, $500 for a married couple both over 65, do not include that extra deduction. So the itemizing decision and the senior deduction are two separate questions on your return. Now, who crosses the itemizing line with the new SALT cap? The homeowners who see a clear benefit share a profile. They live in a state where property taxes are substantial, typically $12,000 or more per year. They also pay state income taxes on pension income, retirement account withdrawals, or investment income, and in some states, on taxable Social Security. And they carry other itemized expenses alongside SALT: charitable contributions above the 0.5% floor, remaining mortgage interest, or medical costs that exceed 7.5% of their adjusted gross income. Here is a concrete example. Take a married couple, both 67, in a state with high property taxes. Their property tax bill is $18,000 a year. State income taxes on their pension and investment income add another $6,000. That is $24,000 in SALT combined. They also carry $7,000 in remaining mortgage interest, $5,000 in deductible medical expenses above the 7.5% threshold, and $3,000 in charitable contributions above the 0.5% floor. Under the old $10,000 cap, their SALT was limited to $10,000. Total itemized deductions: $25,000. Below the $35,500 standard deduction. They took the standard deduction every year, and the extra $14,000 in taxes they actually paid made no difference to their federal return. Under the new $40,400 cap, all $24,000 of their SALT is deductible. Total itemized deductions: $39,000, above the standard deduction by $3,500. For the first time in 7 years, this household crosses the line. Itemizing now beats the standard deduction. At a 22% federal rate, that $3,500 margin above the standard deduction saves them about $770 in federal taxes this year. For homeowners whose SALT and other deductions sit well above the threshold, those paying $20,000, $22,000, or $25,000 in SALT in a high-tax state with meaningful mortgage interest and medical expenses, the annual savings can reach $1,500 to $3,000 or more. Check your own state return too, since some states set their own separate SALT rules that do not automatically follow the federal cap. For a single homeowner over 65 in a state with high property taxes, the threshold to clear is $18,150. A homeowner paying $12,000 in property taxes and $4,000 in state income tax has $16,000 in SALT. Add deductible charitable contributions and any medical expenses above the threshold, and a single filer in a high-tax state may be close to the line or above it. The calculation is worth running. The homeowners who are unlikely to see any impact: those in states with no income tax and modest property taxes, those with no mortgage interest and limited charitable giving, and those whose total itemized deductions simply fall below the standard deduction even after the cap increase. For that group, the change is real in law and irrelevant to their return. Now for the part almost nobody explains: the hidden phase-out. Most quick summaries cover the $40,400 cap. Very few cover what the law says next. The same legislation created a phase-out for filers with higher incomes. If your modified adjusted gross income, your MAGI, exceeds $505,000 for tax year 2026, your SALT deduction cap starts to shrink. The reduction rate is 30 cents for every dollar your MAGI climbs above that threshold. Here is what that means in numbers. Suppose your MAGI for 2026 is $600,000. You're $95,000 above the threshold. 30% of $95,000 is $28,500. Subtract that from the $40,400 cap. Your actual usable cap is $11,900. Barely above the old $10,000 floor. The cap cannot go below $10,000. Once your MAGI reaches approximately $606,000, the phase-out is complete. You're back to the same $10,000 limit that applied under the old law. One design feature worth knowing: the $505,000 threshold applies to single filers and to married couples filing jointly. The same number for both, which is unusual for an income-based limit, but intentional in this legislation. The threshold also increases by 1% each year, paralleling the cap itself. Who reaches a MAGI above $505,000? Among homeowners in or near retirement, the most common paths are a large Roth conversion completed in a single calendar year, which adds the full converted amount to MAGI, a home sale that generates a taxable gain beyond the $500,000 principal residence exclusion generally available to married couples filing jointly, required minimum distributions stacked on top of pension income, Social Security, and investment income in a high balance year, or taxable gain or income from a business or rental property sale. Here is the planning trap that concerns me. You know about the new SALT cap, and you plan your 2026 return assuming the full $40,400 benefit. Then, in the fall, you decide to do a large Roth conversion to take advantage of current tax rates. That conversion increases your MAGI. If the conversion pushes your MAGI past $505,000, the SALT cap phases down at the same time. You made two decisions without connecting them. The tax return connects them for you in April, and not in your favor. There is a second consequence that makes this MAGI number matter even more. Your modified adjusted gross income for 2026 determines your Medicare Part B and Part D premiums for 2028. Medicare applies a 2-year look-back. The Medicare IRMAA brackets run on their own income schedule and thresholds, a separate calculation from the SALT phase-out. But they share the same 2-year look-back from your 2026 MAGI. So if a large conversion or property sale drives your MAGI over $505,000 this year, the same income figure that reduced your SALT benefit is also building your 2028 Medicare surcharge. Two costs, one income figure. The practical rule: before you finalize any large income-generating transaction in 2026, a Roth conversion, a property sale, a large distribution, build a full-year MAGI estimate first. Below $505,000, you keep the full cap. In the phase-out range, you keep a partial benefit. Above roughly $606,000, you're back to $10,000. Plan the conversion or sale with that math in front of you, not after. One more thing before we wrap up. This cap is not permanent, and here are 3 steps to take before year-end. The One Big, Beautiful Bill Act set it as a temporary provision. It applies to tax years 2025 through 2029. Starting with the 2030 tax year, unless Congress acts to extend or revise the law, the cap reverts to $10,000. If your 2025 return has not yet been filed, you have 5 cycles under this provision. If it has, you still have 4 ahead. Your returns for 2026, 2027, 2028, and 2029. Congress may extend the cap. Temporary tax provisions have been extended before. But you cannot build your financial plan around future legislative action you cannot control. Plan for the cycles that remain and treat any extension as a bonus if it comes. 3 steps to take before the 2026 tax year closes. Step 1. Add up your 2026 SALT. Your property tax bill for the year, plus your state income tax payments and withholding. If your state has no income tax, compare that to your state and local sales taxes and use whichever total is higher. That sum is your starting point. Step 2. Compare your projected total itemized deductions to your standard deduction. Add your SALT to deductible charitable contributions above the 0.5% floor, any remaining mortgage interest, and medical expenses above the 7.5% of income threshold. Compare that total to $35,500 if you are married and both over 65, or $18,150 if you are a single filer over 65. If your itemized total clearly beats the standard deduction, itemizing is worth modeling for 2026. If you fall short, the standard deduction remains the right call. Step 3. If your 2026 income might approach $500,000, build a full MAGI estimate before you make any large year-end decisions. A Roth conversion or property sale that takes you past $505,000 reduces or eliminates the SALT benefit at the same time as it builds your 2028 Medicare surcharge. Run those numbers together before you commit, not after. If you work with a tax preparer, the specific question to bring before year-end is this: given the new SALT cap and my projected 2026 income, does itemizing beat my standard deduction this year, and does any planned transaction change that answer? The one thing to carry from today: the $40,400 SALT cap is in effect for 2026, and it can reduce your federal tax bill if you are a homeowner in a high-tax state with enough itemized deductions to clear the standard deduction threshold. But it has 2 gates. Your itemized total has to beat the standard deduction, and your MAGI has to stay below $505,000 to keep the full cap. Check both before you assume the full benefit is yours. The window runs through 2029. The retirees who benefit most from this change are not the ones who heard the headline about the higher cap. They are the ones who checked both gates. This is not financial advice, and every situation is different. The amounts, phase-out thresholds, and filing rules shift year to year, and your state's treatment of retirement income adds a layer that a tax professional in your state is the right person to address for your specific return. If this gave you a number worth checking before April, hit like before you go. Subscribe if you're not already here. There is another retirement tax breakdown coming you will not want to miss. And in the comments, type the word SALT if you are pulling your property tax statement this week to run these numbers. See you in the next one.